All right, a very good morning to you. We're glad you could make time to join us on this webinar. Remember, this webinar is courtesy of PKF and Absa Bank. And of course, the focus for this morning conversation is largely on tax changes and financial choices that we will be engaging you on. We have a fantastic conversation lined up for you this morning. Welcome to the program. My name is Jimmy Mbogo. I'm a business journalist here in Kenya, but today I will be your moderator throughout this session, even as we tackle some of these challenging issues that have come up. My guests are already here with us, and of course, the experts, that is James Mulili from PKF and Kevin Chege, also from PKF. They will be helping us to unwrap some of these hard issues that we really need to discuss even as we plan for our financial futures. Now, the session today is largely going to help you as our customers to be able to know what to do even with this changing taxation regime here in the country, changing tax policies, and what is expected of you. How do you plan better for some of this? However, if you get a question during the presentation, kindly just note it somewhere, or you can put it on the chat of the platform. Then we'll be getting to some of those questions as we go along. However, if you have questions that are outside the conversation that we're going to be having here this morning, we just want to remind you that we'll be providing the right channels that you will get assistance and just to be able to engage you and address some of these challenges that you are facing. And of course, we have our entire teams here at ABSA ready to serve you, and also just to take you to remind you, our customers, on some of the benefits that you as a prestige banking customer should be enjoying. Allow me to take you through some of the things that as ABSA Bank we are planning for you. And of course, so we're talking about financial wealth, and one of the things that comes with financial wellness is the ability to help you plan your finances going into the future. That is one of the reasons why we are tackling this topical conversation here today, looking at taxes. Now, this engagement is not a one-off. This is the very first in a series of many more that are going to come in the coming days, just to help you plan your finances better and also make sure that you do not get caught unaware with some of these changing taxes in the country. We'll also be telling you about your higher loan limits in the coming days, and also the one thing that a lot of you have been talking about is things to do with affordable housing. We know that housing in the country still remains quite a hard nut to crack, even for the government. And of course, we'll be telling you some of the value proposition that we have here at ABSA, which includes a mortgage at 9.5% interest that you can repay for the next 25 years. Now, having said that, it is time for us to get into that conversation, and I just want to welcome James Mulili, a tax director at PKF, to share with us some of his insights even as we prepare to continue with this conversation. James, karibu sana.
Asante Jimmy, and I take this opportunity to welcome everyone to today's webinar. It's quite an emotive issue, I think, for every Kenyan whenever the word tax is mentioned, and this is on the backdrop of the numerous and haphazard tax changes that have happened under the current administration over the last 2 years. The events of the protests were actually evident, and it's clear how critical this tax issue is. And for those individuals, and you'll notice that the theme for today's webinar touches on tax changes and financial wellness. You cannot separate the two issues. The moment any individual earns any amount as income, the very first thing that you'll have to part with, even before you get your net income, is tax. So you can actually see it's actually the very first expense that you have to contend with. Is there an option not to comply? Unfortunately, the answer is no. The financial wellness we are looking at today is particularly focusing on individuals, and the individuals we are actually looking at are both employed individuals as well as self-employed individuals. For employed individuals, it appears to be little bit more direct, because there is the intervention of the employer acting as an agent on behalf of the government to make sure that any requisite taxes in the form of pay-as-you-earn, in the form of withholding tax, in the form of statutory deductions, are actually deducted and remitted to KRA. So there is sort of a safeguard when it comes to employed individuals. The gray area most of the times comes to individuals who are in self-employment. The scope of businesses that self-employed individuals can be involved in is actually quite wide. So we are looking at a whole raft of any form of business that earns an income. It goes without saying that there is no individual who earns an income, even if you are in self-employment. Basically the issue of exemption from tax. So it's still the prerogative of that individual to make sure that you account for taxes. So you could be looking at self-employed individuals who are in the real estate sector, those providing some form of services here and there, whether it's training services, consultancy services. You could also be having individuals who've had maybe the fortune of having some cash. They've put it in a bank like ABSA, in fixed deposits. They've invested in infrastructure bonds, and they're earning some form of income. And the question that comes to mind then, what really are the tax obligations for these two categories of individuals? Are there any benefits in terms of trying to reduce the tax burden for each of those individuals? And then also then what are the available investment opportunities? And I think that's a role ABSA adequately plays in terms of making sure that this happens. So just to reiterate, the focus really is on individuals, and we are basically looking at tax changes and financial wellness of these individuals, whether they are employed or basically they are in self-employment. And the first area we will look at, and as I said, there is sort of some guidance for employed individuals, because then the employer plays a critical role in making sure that any taxes on the employed basically is remitted to KRA by the due dates. So if we just quickly look at this before I even take us through the contents of this first slide, you'll notice that the biggest discussion when it comes to employed individuals is the issue of what is the basic salary. If you look at the employment contracts, that's normally the general structure. But then over and above that, you'll notice that from a tax perspective, any benefit that an employee derives by virtue of their employment is actually considered to be an employment benefit. And whether that benefit is in the form of a cash allowance or an uncash benefit, it has to be quantified and basically aggregated to the basic pay to arrive at the gross pay. So gross pay is actually what is subjected to tax. Over the past 1 week, when SHIF, basically from the 1st of October, when SHIF was effective, there was a lot of confusion with employers, and a lot of queries were being shot to SHA, basically the Social Health Authority, as well as to KRA. The 2.75% is on gross pay. But what does gross pay entail? So in a nutshell, gross pay is basically basic salary plus any other benefit that an employee derives from employment. However, you will note that in as much as you're saying gross pay will aggregate all these other benefits, there is normally some reprieve in these benefits. And the very first benefit, for example, is what you normally refer to as the meal benefit. The employer can actually provide meals to its staff, but if the amount does not exceed 4,000 shillings per month per employee, then in as much as it's a benefit to the employee is not taxed on the same. However, if the amounts exceed 4,000 shillings, then in the employee's payslip, there will be an additional benefit in the form of a meal benefit. Now, as we move along towards the end of our presentations, my colleague Kevin will actually point us to some of the proposals in the Tax Laws Amendment Bill that seek to sort of give more, or rather to cushion employed staff from these excessive taxes. And you'll be able to see some of these good proposals, which were actually contained in the Finance Bill 2024 that was withdrawn. So is this a way for the government to just soften the ground before the end of the year? Then come 2025, then we are hit with another Finance Bill 2025 with a whole raft of tax changes. I guess we'll just have to wait and see. The second kind of benefit to employed staff that is very critical is a motor vehicle benefit. And the motor vehicle benefit ends up being a very costly benefit to the employee. Now, the way motor vehicle benefit works, you find that an employer like ABSA has purchased some motor vehicles. And these motor vehicles owned by ABSA are actually allocated to particular staff. And these staff not only use these motor vehicles for business activities, they also have the opportunity to utilize the vehicles for their personal use. Now, remember that employee who's been allocated that motor vehicle is enjoying that benefit of using the motor vehicle by being an ABSA employee. So automatically, and in line with what I indicated, any benefit from employment is construed to be a benefit that should be subjected to tax. So how does the government, or how does KRA, or what do the laws provide in terms of valuing that benefit? It is actually assumed that the hire of 2% per month of the original cost of that vehicle or the commissioner's prescribed rate becomes the benefit. Now, by default, ideally what should happen is that 2% of the value of that motor vehicle becomes a benefit. What does that really mean when you look at the payslip or the payroll? You'll find that over and above the basic pay, you'll have a 2% of the value of the original cost of that car as a motor vehicle benefit. When aggregated to the basic pay, you get a higher gross pay. So the higher, obviously, the value of the motor vehicle, the higher the benefit, the higher the pay as you earn to be paid, the higher the affordable housing levy, the higher the SHIF to be paid consequently. If ABSA, for example, instead of purchasing the motor vehicles, it has leased the motor vehicles, the value of the benefit is actually the amount of lease that is paid. So you can actually see how that now starts varying the payslip in terms of the amounts that are being subjected to pay as you earn. Another very common benefit is housing benefit, where you find the employer is actually paying basically for the housing arrangements for its employees. And there is normally sort of a categorization in tax as to how to derive the value of the benefit. For company directors, it's the higher of 15% of the total income, basically the gross pay. You can actually see what is resounding when it comes to employed individuals. The issue of gross pay keeps resounding because it is actually the base upon which taxes are based. So for directors, you're looking at the higher of 15% of the total income, or the fair market value, or the rent that is actually paid. There is a special sort of consideration for agricultural employees, because it is assumed that for a lot of companies that are involved in agricultural activities, the employees really have to be housed. So you'll find that the housing benefit is at a lower rate of 10% of the total emoluments, which still goes back to the gross pay. For other employees, similar to the directors, it is the higher of 15% of the emoluments. The rent paid by the employer, or where the premises is owned by the employer, what is actually considered to be the market rental value. If we move to the next slide, other benefits, we have any utilities that are being paid by the employer on behalf of the employee. And this mainly happens basically at the employee level of top management, where you find the employer is actually paying for some personal expenses at the employee's premises. The employer could be paying for the domestic workers, could be paying for security, could be paying for any other personal expenses. These are also considered to be benefits, and the value of those utility bills that are paid by the employer on behalf of the employee are aggregated to arrive at the gross pay. Telephone benefit is another common benefit, where it is always assumed if the employer is actually paying basically telephone bills for the lines that the employees are using, it is assumed that 30% of that telephone bill has been used by that employee for personal purposes, and is a benefit that is aggregated to arrive at the gross pay. Then we also have scenarios where employers actually give loans to employees at very low interest rates. That is normally referred to as fringe benefit tax. And that as well amounts to a benefit to the employees. So as we move along, you can actually get the drift that any facility or any enjoyment or any benefit that employed individual is enjoying by virtue of being in employment is actually considered to be an employment benefit subject to tax. Other common benefits: if the employer pays for any club entrance or subscription fees. So you are an employee, the employee is actually paying the subscription fees to a golf club. That as well is a benefit that should be taxed on the employee. For those individuals who are in professional bodies, it could be ISPAC, it could be the LSK. Those subscription fees that are paid are considered to be a benefit on the employee if they have not been taxed on the employer. So when we say if they've not been taxed on the employer, what we mean is at the end of the year, when the employer is preparing their tax computation, those expenses are not considered to be tax deductible expenses on the employer. So that's how to tax the employer. So if it's been taxed on the employer, then it does not constitute a benefit to the employee. However, if the employer has actually not considered these professional subscription fees as deductible expenses, then they become an employment benefit and taxed on the employee. So that's another area to check. Then any reimbursements as well are considered to be benefits. For those employees who have to go out of station to perform business activities, we have what we call the per diems. And per diems are actually supposed to make sure that they reimburse the employee for all the expenses incurred in the furtherance of business. But the way the per diems are normally treated is that the current non-taxable per diem amounts is that any amount below 2,000 shillings that is expended by that employee per day is not considered to be a taxable benefit. For any excess amounts beyond the 2,000 shillings, for them not to be subjected to pay as you earn as an employment benefit, there has to be support of documentation of the incurring of those expenses. So if it's accommodation, and the accommodation, basically the transport and the meals have exceeded the 2,000 shillings, the employee is actually supposed to furnish the employer with documentation in order to substantiate that indeed that was an expense that was incurred, and it was an expense that was incurred in the furtherance of business. Then mileage claims: employees who use their personal cars to perform business activities on behalf of the employer, you can actually get your mileage claim back. It's not considered to be a benefit subject to tax. For the longest time, there was a lot of confusion as to the mileage rates to be applied. The Finance Act 2023 clarified that basically the mileage rates to be applied are those that are approved by the Automobile Association. Then we also have a lot of employers who incentivize their employees by making sure that they give employees some stake in the company in the form of employee share ownership plans, ESOPs. There is a benefit that crystallizes from the issuance of ESOPs as well, and is basically looking at the price of that share when that option was granted to an employee versus the price per share when the employee decides to actually exercise the option, and exercising the option is actually to take up that option. So it's also important from an ESOP perspective, and ESOP stands for Employee Share Ownership Plan, for the employer to make sure that there are necessary safeguards, and for the employee to be aware, in as much as there is that incentive to have a stake in the company in the form of an ESOP, there is a tax benefit that is subject to tax that might crystallize, and it basically compares the share price when that option is granted versus the share price when the employee exercises that option. There are also instances where employers buy furniture for the employees at their residences, It is still a benefit. Remember, the employee is enjoying that by virtue of being an employee in that company. And 1% of the cost of the furniture then per month becomes a benefit that is subject to tax. So you can see tax can be very complicated. There are so many nitty-gritties that are hidden here and there. And the unfortunate thing is that when KRA comes, you can never say that you never knew. So this first series of these webinars is supposed to sort of set the ground so that at least that basic information is available to everyone in terms of now trying to understand this is actually how my employer computes taxes. This is the reason as to why I can see additional benefits in my payslip, and this is the impact it has overall. Now, if we move to this slide, remember when I started, there was a mention on sort of having two categories of benefits. Those that are cash in nature. So when we say a cash benefit, any form of cash allowance that is given to an employee is considered to be a cash benefit. And that one outrightly is aggregated in the payslip to arrive at the gross pay. Now, the other category of benefits, we have non-cash benefits. Now, and someone might ask, isn't motor vehicle benefit, isn't the telephone benefit, isn't the furniture benefit non-cash benefit? The answer is yes. But the difference with those other benefits, motor vehicle, furniture, housing, they have a prescribed rate to arrive at the value of the benefit. Now, there are those other non-cash benefits, and a good example, especially as we are heading towards the Christmas period, you find that employers give shopping vouchers to their employees. And the question is that a benefit? The answer definitely is yes, because that employee is getting that shopping voucher by virtue of being an employee. But then now, if we set aside those benefits that have prescribed rates that we've mentioned before, the housing, the motor vehicle, telephone benefit, furniture benefit, any other form of benefit that is not cash in nature is put under that category of non-cash benefits. However, the way it works for non-cash benefits, if the value of that benefit is less than 3,000 shillings per month, which translates to 36,000 shillings per annum, that non-cash benefit is not subjected to tax. Now, for directors who have more than 5% shareholding in a company, they are entitled to a tax-free medical benefit up to a maximum of 1 million shillings in terms of the medical cover per annum. For partners and those in sole proprietorships, similar tax-free medical benefit up to a maximum of 1 million shillings of the medical cover per annum. Now, there is a benefit called, basically, don't call it education policy, I'll call it school fees benefit. And also you find that there are instances where employers pay school fees for their employees for furtherance of their education or for the dependents of the employees. And I think this is a common practice in terms of employers just trying to cushion employees from adverse tax effects. Now, the school fees benefit is actually is the only unique benefit where, in as much as the employee is enjoying that benefit by virtue of being an employee, the taxing rights of that benefit can move to the employer. And what I mean is this: the employer can actually be taxed on the school fees, which cushions the employee from having to consider the school fees paid on his or her behalf as a benefit and having it aggregated in their payslip. So school fees benefit is unique. And what normally happens, you find that for those employers who are willing to pay school fees on behalf of the employees, the employers are the ones who pay the tax. And the way I explained how employers pay tax, at the end of the year, when the employer is preparing the tax computation, the school fees, which is normally expensed in the profit and loss account, is not considered to be a tax deductible expense. So it increases the employer's profit by that amount, and the employer pays tax on it, and the employee does not need to pay any tax. So non-taxable benefits, I had already touched on the meal benefit, where if it's less than 4,000 shillings per month per employee, then it's not taxable. The issue of pension contributions come in, and employees are basically entitled up to a maximum of 20,000 shillings per month, which comes to 240,000 shillings per annum, as pension contributions that are not subject to tax. So after you've arrived at the gross pay up there, you are entitled to claim up to a maximum, or rather to deduct up to a maximum of 20,000 shillings as an employee, which is not subject to tax. So you'll have the gross pay, you deduct the pension contributions to arrive at what we normally refer to as the taxable pay that is now subjected to pay as you earn. Then the issue of the medical cover I've mentioned in the previous slide. For expatriate employees, they are allowed what we call leave passages. And leave passages basically are the number of times in a year the expatriate employee is allowed to go back to their home country. And many a times under that expatriate arrangement, you find that the employer actually caters for the air tickets and any other costs for that particular employee. So leave passages are allowed for these expatriate staff to go back to their home country as part of that arrangement and under employment. And the expenses incurred for the leave passages do not amount to a benefit taxable on that expatriate staff. Then I've mentioned the issue of professional subscriptions. They are only a taxable benefit on the employee if not taxed on the employer. Any reimbursement of expenses, of business expenses to the employee by the employer do not amount to a taxable benefit. A good example was the issue of mileage allowance, but generally any other expense that an employee incurs as part of basically furtherance of business, and the employee comes back with proof of those expenses and those amounts are reimbursed to the employee, that does not actually amount to a taxable benefit. Now, for those employers who have any employees with any form of disability, this is actually something very good that should be explored. The employees with disability can be able to be given tax exemption certificates. And what this affords the employees with disabilities is that on the first 150,000 shillings of their gross pay per month, they are exempt from tax. So you can actually see how that is beneficial to employees with disabilities. Then, in as much as we are talking about any form of benefit being subject to tax, there are also some reliefs that are normally given. And what normally happens with the reliefs that you can see on the screen is that after you've computed the pay as you earn, then you are allowed to deduct those reliefs from the pay as you earn in order to reduce the pay as you earn due to KRA, and so that the employees can have some more disposable income. The first relief that we encounter is personal relief, which is normally at 2,400 shillings per month. In total, per annum is 28,800. For those of us, and I believe a majority of us being ABSA clients, we have some form of insurance policies, whether it's life insurance, education policies, health insurance. You are entitled to insurance relief as well. And it's normally 5% of the premiums paid, up to a maximum of 60,000 shillings per annum. So per month, you get up to a maximum of 5,000 shillings as insurance relief. Then you have mortgage relief. I think this is also very, very beneficial. As ABSA clients, I believe some of us have mortgages. Take advantage of the mortgage interest relief. It's actually a substantial amount because you get a relief of 25,000 shillings per month, which comes to 300,000 shillings per annum. Then we also have the post-retirement medical fund, which also affords you that relief, basically 5%, 15% of the amount contributed, capped up to 60,000 shillings per annum, which again translates to 5,000 shillings per month. The affordable housing levy, there's also an affordable housing relief. which is basically 15% of employees' contribution, up to a maximum of 108,000 shillings per annum. On a monthly basis, it's up to a maximum of around 9,000 shillings per annum. But then, you see the question we've asked the Finance and Planning Committee severally. If you compute 15% of 1.5% of the gross salary, depending on the gross salary that an employee receives, you find that that affordable housing relief also ends up being meager. And those are the same sentiments we've extended to the other reliefs. And actually, Kevin will point us to the thinking that the government has with regards to enhancing some of these reliefs so that they're beneficial to employees. Now, if we move to the next set of slides, I will just quickly take us through what are some of these tax considerations for individual-owned businesses. So we are sort of moving from the employed individuals to those guys who are in business. Now, the scope under these slides can be very wide because you can imagine the different nature of businesses that self-employed individuals can be involved in. It could be real estate. Someone is running a small kiosk. Someone is in the in a real estate sector. So the businesses are actually varied. Now, the rule of thumb generally, even if you're doing business as a self-employed person, you are actually entitled to pay your taxes in the form of, it's like corporation tax. You're actually paying taxes at the rate of 30%, which is the corporate income tax rate, and you are allowed to actually claim your expenses. Now, that is the general approach to the taxation, even for self-employed individuals. But then the question is there an alternative? As opposed to paying taxes at 30% on profits or gains, then having to support each of those expenses, and just so that you are aware, for any taxes for the 2024 year of income, for you to claim any expense, you must support that expense with an ETIMS invoice. The only expenses that are excluded from being supported by an ETIMS invoice are salaries, basically emoluments, because for those ones you don't have, your employees don't issue invoices. Any imports as well are exempt, and any interest payments, those are exempt from the requirements of expenses having to be supported by ETIMS invoices. Now, the alternative for self-employed persons and smaller businesses is something called turnover tax, which is applicable to businesses with an annual turnover of between 1 million shillings to 25 million shillings, basically per annum. So you actually qualify for the turnover tax regime. And for you to take advantage of the turnover tax regime, you must make an application to the commissioner and have yourself registered for turnover tax, which will now sort of which will supersede the income tax obligation that comes by default when you get a KRA PIN. Now, what is the rate of turnover tax? You'll notice that the rate of turnover tax is lower, is actually at a rate of 3% of the turnover, and that's why it's called turnover tax. So this is an opportunity for smaller businesses, for people in self-employment to take advantage of. Whilst it might appear that 3% of overall turnover is high, you have to note that it is a simplified way of accounting for taxes that does not give small businesses the administrative headache of having to maintain a lot of documentation when it comes to supporting expenses. And it's very straightforward in terms of complying. Now, however, in as much as turnover tax is a viable option for self-employed persons and even salaried persons who have any other businesses, you'll notice that there are certain business activities that are exempt, that are excluded from the turnover tax regime, and one is rental income. Rental income is actually considered to be a separate source of income. So even if a business has its main business activity and also owns rental property, for purposes of accounting for tax, rental income should be separated from the other businesses, and the assessment for tax done as a separate source of income. Now, for rental income as well, and like we indicated, today is only the beginning. And some of these issues, we will actually be able to delve into them, because even for rental income purposes, it depends what is the type of rental property. Is it commercial property? Is it residential property? So the quick giveaway for today is this: if you are an individual, or even if you are a salaried employee, and you have that one house or 2 or 3 residential premises where you are getting an annual turnover of less than 15 million shillings per annum, don't burden yourself with a lot of taxes at 30% on gains on profits. Go for something we call residential rental income tax. You can apply to fall under that regime, and you'll only be paying 7.5% of the rent received as tax. So it's an easy win for guys or for individuals rather, who are involved in the residential rent space. Any person who's providing management, professional or training services, those businesses as well are excluded from turnover tax. Remember, management, professional training fees are subject to withholding tax, so there's a different regime for that. And basically, any income which is subject to a final withholding tax as well is excluded from turnover tax. So yes, in as much as turnover tax is available, there are certain exclusions that are very important. The other thing to mention, even as individuals, any business that you conduct, and it happens that whatever you are supplying, whether it is services or goods, and it happens that those services or goods are subject to VAT, if your annual turnover is more than 5 million shillings, whether you are an individual or a company, you're actually supposed to register for VAT, charge VAT to your customers, and you are entitled to claim any input VAT that you are charged on your purchases. So it is very important for individuals to note, maybe more important for self-employed individuals if you are in business, whether you are providing services or you are supplying goods. If your annual turnover is more than 5 million shillings and the category of goods you are dealing with are subject to VAT, you have to register for VAT and comply. However, given the advancements in the technological space, there are a lot of individuals who are involved in the provision of digital services. And digital services is basically any service that is provided over the internet, on any electronic network or through a digital marketplace. The requirement to register for VAT is not pegged on the 5 million threshold. Any person offering digital services in Kenya, regardless of the amount of turnover per year, you are supposed to register for VAT and charge VAT. I'll not overemphasize the issue of eTIMS invoices. I've already touched on it. It is important to have eTIMS invoices if you're going to pay taxes based on your profits or gains, where you have to claim your expenses. You need to request your suppliers to give you eTIMS invoices. There's also an issue of advance tax. As self-employed persons or even as salaried persons, you could be running this side hustle where you've registered a commercial vehicle that you use to transport your goods. There is something called advance tax. So this is applicable on commercial vehicles at the point of doing the inspections. I've touched on the issue of rental income for residential properties. The rate was previously 10%. It was reduced to 7.5%. So that is actually a very good opportunity if you have that residential premise somewhere where you earn some rent. Now, just a quick overview on withholding tax. Withholding tax is normally applicable on certain qualifying payments. Now, the most common withholding tax applicability I can think of for individuals is largely those individuals who are involved in the provision of services, professional services, training services, consultancy services, what you need to know and always expect, by the time you are being paid for those service offerings, the person making that payment to you has the obligation to deduct withholding tax. I'm assuming we are all Kenyan residents at the resident rate of 5%. And even for those of the ABSA customers who have some form of fixed deposits and there is interest being earned, you will always notice that ABSA deducts withholding tax at the rate of 15% on the interest that you earn. So that is, in a very simplified way, the operation of withholding tax. It is deducted at source, and it should actually be remitted to KRA within 5 working days. So it's important to note that. So it's another form of agency tax where the person making the payment that qualifies for withholding tax is required to deduct and remit the withholding tax to KRA within 5 working days. I will not belabor so much on this slide, but just to highlight some of the payments that qualify for withholding tax deduction. So you are this individual, whether you're salaried or you're employed, or you are self-employed, and you're earning a consultancy fee, you're earning a professional fee, you're earning a management fee, there is withholding tax that will be applicable. However, for management or professional fees, if the services you have rendered in a month, if they are less than 24,000 shillings, you are exempt from basically the withholding tax requirement. Anything above 24,000 shillings, specifically for management fees, professional fees, or consultancy fees. If below 20,000 shillings, then whoever is paying you that payment will not have to withhold. But for all the other payments, withholding tax is applicable. So training fees, so you're an individual, you have a side hustle of doing some training and you're paid, there's withholding tax. For those of us who provide any form of contractual services, and contractual services involves any service in the nature of involving a building, civil or engineering works, there is also withholding tax applicable that, but at a lower rate of 3% as opposed to the 5% I've mentioned. If these payments are actually being made to an unresident person, the withholding tax rate is higher at a rate of 20%. So I hope that sort of puts into perspective the expectations in terms of withholding tax. Then other qualifying payments that are subject to withholding tax, if you earn any dividends as an individual, you could be an individual who's a shareholder in a company, you own shares in a listed company and you're being paid dividends, those are normally subject to withholding tax. I've mentioned the issue of interest. For example, on any FDs, you'll always notice that withholding tax is deducted. And basically the other sort of payments that are contained in that slide. Then there are certain exemptions for withholding tax purposes. Might not be necessarily directly applicable to individuals, but yes, you could be an individual who's involved in maybe floriculture or horticulture sector, and you're actually selling your produce to the auction market. Any commissions that are earned from such activities, or rather any commissions that basically you have to pay, are exempted from withholding tax. So that brings us to the end of the first session. I hope it was informative. As I mentioned, it's only the beginning. We will actually explore these issues in further details, and I'll take this opportunity to thank you for listening through and hand it over back to Jimmy.
All right, thank you very much, James. And of course, quite an insightful presentation. A number of things that have actually stood out for me is the number of taxes that we have to pay. And I'm sure so many of us who are following online maybe did not pay keen attention to this. I mean, when you look at something like per diem over 2,000, when you look at something like motor vehicle benefits, airtime, furniture at 1%, and even the shopping vouchers that you'll be getting over Christmas holidays, remember that will make part of your gross salary and then increase your taxes. So some of these benefits, and I'm sure, James, one of the questions that a lot of our viewers maybe might want to ask is, so what is the right way? Do I take it? Do I take some of these benefits, or do I say no? Hold on to that thought. We'll get to that conversation in just a moment. Now, I'm told we are at over 140 people following this conversation, and we just want to thank you all for making time to be part of this conversation. Just taking you through some of the benefits that you can take on from your taxes. These are the non-taxable benefits. For instance, pension, professional subscription. We're looking at expatriates, for instance, medical cover, disability exemption, and a few other things. And of course, those are some of the benefits that are not taxable. When you look at some of the reliefs that you can enjoy, we're talking about personal reliefs, which amounts to about 28,000 annually. We're talking about mortgages, insurance. This is on health, education, and life at 15%. That is, of course, exempted. We're talking about affordable housing at 15% and post-retirement medical funds. Now, these are some of the reasons that we are having this conversation, just to be able to walk with you and help you understand how to manage your taxes. What are some of the expectations, and how best can you go about your financial planning and your financial wellness journey, just to make sure that you take advantage of some of these. And to also remember, when we started this conversation, one of the things that we said, the point of this conversation is walking with you in your financial wellness journey, and also to ensure that you live your best life. What does that look like? I mean, going forward, you will be getting access to a prestige banker who will work with you and give you financial advice going forward, and making sure that your everyday banking is convenient. You get to enjoy when you have to deal with all these taxes, then the last thing you want when it comes to your banking is another headache. So we're trying to make sure that that process is quite easy for you. And of course, soon you will have access to prestige banking centers across the country to ensure that we enhance that experience. Now, we've heard from James. I want to bring Kevin into this conversation to also take us through his part of the presentation. And Kevin, thank you so much for making time to be here with us. I'm sure you've seen the presentation that has been made by James, and I know you have more insights to give us. So I want to yield the floor to you to take us through your presentation as well.
Thank you so much, Jimmy, for the introduction, and thanks, James, for an elaborate discussion. My second session of this presentation will guide us through the statutory deductions that are levied on our pay slips, or that are levied on employed individuals, and as well as individuals in self-employment. At the tail end, I will also take us through the proposed changes in the new bills that have been floated, the Tax Laws Amendment Bill 2024, which in one way or another tries to resuscitate some of the provisions that were there in the Finance Bill 2024, albeit the good provisions. So without further ado, my first session will be on the statutory deductions, and I want to start with the NSSF contributions. And the question we have been getting a lot in the recent past, as online and even as tax practitioners, is, are our NSSF contributions going to increase next year? And the straight answer to that is yes. And what happened, maybe I'll give just a brief chronology of the events towards the NSSF Act 2013. So NSSF Act 2013 was passed into law in 2013. However, in 2014, there were people who went to court, and there was an injunction on the implementation of the NSSF Act 2013. So across the years, there have been numerous litigation, which culminated into a decision of the Court of Appeal on February 3rd last year, that is 2023. And that marked the end of that litigation process, and NSSF Act 2013 came into law. So what was provided for in the NSSF Act 2013? It upped the contributions made to NSSF to a contribution of 6% of the pensionable earnings. So it provides for two tiers of contribution. There's what we call the lower earnings limit, or the tier 1, and the upper earnings limit, or tier 2. I'll focus much more on tier 2 because our audience is basically people who are in the ambit of that tier 2. So in the first year of contribution, which was last year, and there was a notice that was issued immediately after the court ruling by NSSF, providing that the first year of contribution commenced in February 2023, provided that the upper limit of the contributions were to be pegged at 6% of the national average wage rate at the rate of 36,000 shillings, and it was to be pegged at 50% of the contribution. So if you do 6% of 36,000 and at 50%, you get your contribution at 1080. So that informs why our contributions to NSSF shifted to 1080 last year. Now, early this year, in February, there was another public notice issued by NSSF providing that year 2 contributions commenced in February 2024. So the Act provides that year 2 contributions will be 6% of the national average earnings times 100%. So this one provided for 6% of 36,000 straight on at 100%. So that gives us 2160, which has been the contribution for this year. Now, come year 3, which commences in 2025, the amount of contribution will be 6% of the national average wage rate times 200%. So essentially what we are saying is that the contributions to NSSF come February 2025 are going to double from 2160 to double that amount. And year 4, which commences on 2026, it will be at 300%. And year 5 onwards, it will be at 400%. Now, the interesting bit about this is that as much as we are saying that the contributions will increase to double the amount, remember we are pegging it on the national average wage rate. If you look at the NSSF Act 2013, it provided that the national average wage rate was to be the amount that is published by the National Treasury in the Economic Survey report of the prior year. So the 36,000 that we are applying here is the national average wage rate for 2012. So what if, this is a what if scenario, what if the NSSF were to apply the most recent national average wage rate? I think last I checked, the amount was around 68,000 shillings. So our hope and prayer is that the rate will be maintained at 36,000 shillings. But what is certain and sure is that our NSSF contributions are going to double come February next year. So in terms of NSSF contributions, remember, it's both by the employee and the employer. So whatever the employee contributes, the employer matches with a similar amount. I think, yeah, that sums up what is provided for in the NSSF compliance, and there is a penalty of 5% of the amount to be paid by the employer in case the employer does not meet the contributions to NSSF by the due date. The next one, I think it's something that we've all interacted with and has been the talk of so many of us in the last 1 month or 1 month and a half. It relates to the social health insurance contributions, which became effective from 1st October 2024 at the rate of 2.75% of the gross income. There has been a lot of conversation about what constitutes gross income, and like James mentioned, this is both the gross pay and any regular payments, excluding any non-regular payments that are made to an employee. So again, on this issue of social health insurance fund contribution, there were a lot of queries as to whether it qualifies to the relief. Remember, James talked about a 15% relief on contributions to the National Health Insurance Fund. And as late as last week, we got a circular, a public notice from the KRA pointing out that contributions to Social Health Insurance Fund are not subject to the 15% relief, which to our thinking, it was quite a premature public notice, because the reason why they give is not to advance the relief on SHIF contributions is because the Tax Laws Amendment Bill provides for that contributions to SHIF will be an allowable deductions. I think it should have waited that the tax laws amendment bill is assented into law, so that they give that public notice. But as it stands, the public notice provides that shift contributions are not subject to insurance to relief of 15% on the contributions. Key to note is that shift contributions do not require the employer to match the contribution, so it's solely pegged on the contributions by the employee. There is the issue of affordable housing levy. Remember, this was brought in by the Finance Act 2023. It went through a series of litigations where it was ruled to be unconstitutional to the extent that it was not a tax statute that wants to be amended through the Finance Bill of Finance Act of 2023. However, immediately the government went in and published the Affordable Housing Levy bill, which was assented into law as Affordable Housing Levy Act early in the year, and now effectively from February or March this year, we have had the affordable housing levy contributions at the rate of 1.5% of the contributions by both the employer and the employee per month. So that gives a chronology of what we went through in terms of the affordable housing levy until now. We have the Affordable Housing Levy Act that stipulates that the contributions to that fund are at the rate of 1.5% of the gross earnings of an individual, and the employer has to match up that contribution. So there was the issue of whether non-salaried persons are supposed to pay affordable housing levy, and it became one of the litigation issues because to an extent the levy was discriminative because it was only providing for salaried individuals. So what the Act did, the Affordable Housing Levy Act, provided that even non-salaried individuals are supposed to pay affordable housing levy on their income. There were regulations that are supposed to provide the mechanisms of those deductions to be issued on how individuals are supposed to be paying affordable housing levy on their individuals who are not salaried are supposed to pay affordable housing levy on their income. I think the last item on that is that where the KRA issued a public notice clarifying that gross monthly salary includes regular payment or regular salary items like housing, travel and commuter, car allowances and other such regular payments, but excludes non-cash as well as payments that are not paid on a regular basis, such as leave allowance, bonuses, gratuity and so forth. So I think that informs the affordable housing levy contributions, which we have been paying at the rate of 1.5% going forward. Now, I think we are all aware of the happenings of Finance Bill 2024 and the events that led to the eventual non-assenting of the Finance Bill 2024 by the President. And I don't want to belabor so much into that, but it's important to say that the Finance Bill 2024 had a mixed bag of goodies. There were good provisions and there were those punitive provisions that were contained in that bill. As an effort to resuscitate the Finance Bill 2024, we have seen the government publish several bills as late as last week and last week but one. We have the Tax Laws Amendment Bill 2024. We have the Tax Procedures Amendment Bill 2024, and then we have the Business Laws Amendment Bill 2024. So these bills are trying to give life to the good provisions that were contained in the Finance Bill of 2024. There are a few, of course, notable punitive provisions, but we have seen the government take a very cautious move to ensure that the punitive provisions are not introduced at this moment, but try to soften the ground with the good provisions, especially those ones covering employees. So in this presentation, we have tried to pick up the good provisions or the notable provisions that affect employees. The first one is that James talked about meal benefit, which is pegged at a maximum of Kenya shillings, 4,000 shillings per month. I think we all know in the level of economy where we are, the level of inflation, the cost of living, 4,000 shillings in terms of meal benefit for a month is quite a low amount. So the bill intends to uplift that amount from 4,000 shillings to 5,000 shillings per month, or 60,000 shillings per annum, which will be the tax-free benefit in relation to meal benefit. The bill also proposes to exempt the contributions made to a registered pension scheme to a maximum of 360,000 from the current 240,000 shillings. So what happens is that up to a maximum of 20,000 shillings per month contributions, or 240,000 shillings per annum, is a tax-free benefit to the employee. So that will be upped from 20,000 to 30,000 or 360,000 per annum. The bill also proposes to increase the aggregate value of non-cash benefits. Remember, James talked about non-cash benefits. If you receive any form of non-cash benefit from an employer, in terms, the most notable one being if you receive any shopping vouchers, it is tax exempt up to 36,000 shillings. So there is a proposal to increase that threshold from 36,000 shillings to 60,000 shillings as a tax-free benefit. So if you receive vouchers up to 60,000 shillings per annum, or 5,000 shillings per month, that will be a tax-free benefit. It will not be taxed on the employee. Other notable proposals, and this brings about a very important discussion. We've talked about reliefs, and reliefs tend to offer you a relief from tax. So you compute your tax, you find that your tax is X amount, so you are given a relief from tax on that amount. And the discussion has always been, which one is better? Is it a relief, or is it giving forth an allowable deduction? And the answer to that is that an allowable deduction provides more cushion, or it's advantageous to an employee than a relief, because an allowable deduction ensures that the amount is deducted before your salary is subjected to tax. So it becomes an amount that reduces your taxable pay, as compared to a relief which reduces your tax payable. So what has happened is that we had several reliefs. We had the affordable housing relief. We had the social health, the NHIF relief at the rate of 15%. So the bill has proposes to scrap those reliefs and instead provide that contributions to SHIF and affordable housing levy will be allowable deductions when the employee is computing their taxable pay. So in a very simple scenario, if your salary is 100,000 shillings, we are saying 1.5% and 2.75% would be deducted from 100,000 shillings before we can subject the net amount to taxation. This is unlike the previous scenario where the 100,000 shillings, holding everything constant, would have been subjected to tax, and the amount that you are paying on tax on, you'd get a relief of 15% of the contributions. So this is a welcome proposal, which will ensure that employees are cushioned from the high contributions related to SHIF and affordable housing levy. The same also goes for contributions to post-retirement medical fund, but this comes with a cap of 15,000 shillings per month. The bill also, in the same breath, will repeal the reliefs that are provided in the affordable housing levy, as well as in the NHIF relief. For those of us who do business with the government being the biggest purchaser of both goods and services in the country, there has always been the argument that most people who do businesses with government don't pay their fair share of taxes. So in an effort to cushion that, is that there will be a withholding tax levied by the government institutions for those persons who supply goods. Remember, services are already subject to withholding tax. So if you supply goods to the government will withhold tax at the rate of 5%. What is not quite clear is whether that 5% will be an advance tax or will be a final tax. But going by the way this proposal is anchored and the intention, this ought to be an advance tax so that you are able to declare the full amount that you have provided to the government and pay taxes on the same. In terms of calculating the tax days, in terms of when you are lodging any objection or an appeal, when you get an assessment from the KRA, you have 30 days to lodge an objection if you are in dispute of the taxes. So we calculate the 30 days as calendar days. So there's a proposal to exclude weekends and public holidays in the computation of those days for appeal. The other issue would be on the tax amnesty. Last year, through Finance Act 2023, there was an introduction of a tax amnesty where if you are a taxpayer in Kenya, let me use the word taxpayer because this covers both individuals and persons who operate businesses or companies. So if you are a taxpayer in Kenya and you had any penalties up to 31st December 2022 and you had paid the principal tax, you are entitled to an amnesty on the penalties and the interest at the rate of 100%. If you had not paid those penalties and interest, you are given an opportunity to enter into a payment plan with the Kenya Revenue Authority up to 30th June 2024, whereby if you are to pay the principal tax or you enter into an arrangement to pay the principal tax by 30th June 2024, you would be entitled to a relief or an amnesty on the penalties and the interest. So there's a proposal to revive this provision to extend the amnesty period up to 30th June 2025, which is a welcome proposition, so that it gives people a window to settle and to clean up their tax affairs up to the period 30th June 2024. However, one thing that is notable is that the base period or the cutoff period has still been retained as 31st December 2022. And as part of our submissions to the National Assembly and the Treasury on this bill is that we will be praying for them that they extend that base period from 31st December 2022 to 31st December 2023 so that even persons who have any tax dues up to 31st December 2023 can take advantage of the amnesty. I have talked about the shift contributions and the insurance relief. I think I don't want to belabor on that. Before I hand over back to Jimmy, I think there was one important thing I ought to have mentioned. You just allow me to go back to it. Still on the NSSF contributions. So as much as we are saying that our contributions are going to double next year, and taking cognizance of the challenges that we have had at NSSF, the Act provides that individuals can opt out of the Tier 2 contributions and make those contributions to a registered pension scheme that is approved by the Retirement Benefits Authority to manage pension funds, so that you only make contributions on the Tier 1 contributions to the NSSF, which is a welcome proposition or a welcome move which we should take advantage of and get in touch with our financial advisors like ABSA so that they can advise on the contributions to be made to a registered pension scheme where you are bound to get better returns on your contributions to the NSSF. I think at that point I will hand over back to Jimmy for the next session on the Q&A. Thank you very much.
All right, thank you very much, Kevin. Of course, a lot of interest coming from our audience this morning, and a lot of questions have been filled in. But of course, one of the things that I'm sure is likely to continue being a pain for a lot of them is the fact that NSSF contributions are likely to double. And I think out of the presentation that you've just made, I'm sure for anyone who's already struggling to pay taxes and thinking these are way too many taxes that we have to pay as a people, then that does not encourage anyone. But of course, this is exactly why we are having some of these conversations. This is the point of organizing such a forum. And just to remind you, as ABSA Prestige banking customers, there are other benefits that the bank is making sure that you can enjoy. One of them, of course, cognizant of the environment that we are currently operating in, is cashback when you use debit and credit cards for all spending. Of course, exclusive discounts from select merchants, and we're also talking about a free retrenchment cover for Prestige bundle accounts. Basically, just trying to make sure that even as we understand that the times are quite hard, they're also trying to make sure that you are cautioned. The other thing that they are providing for is education policies to secure your children's future, and also expose you to the fun and fine things to just make sure that you, again, get a way to release some of this stress. Now, gentlemen, a lot of questions have come in, and I'm sure this is the part that we were all looking forward to. But one of the things that we are seeing on and over and over again from the feedback that we are getting online is the shift contribution. And we, for instance, here is a question from Danny, who's asking, away from that shift contribution, is just saying, on the NSSF issue, what is the effect of the Supreme Court of Kenya ruling in February this year?
The cases on NSSF ruling were all extinguished, and that's why the act has been in effect from February 3rd last year. So that's why I mentioned that progressively, as had been provided for by the NSSF Act of 2013, the rates are going to increase on a year-by-year basis. So the first year, which was last year, was 6% times the national average wage rate times 50%. Second year, which is this year, 100%. Third year, which is next year, 200%. The 100%, the other year, 400% going forward. So it's capped at 400%. So we are going to see progressive increases on the NSSF contributions going forward. And what we have seen is that every February from last year, this year, the NSSF has been very prompt in issuing that public notice, notifying employers, because the obligation is based on the employers, that the contributions are meant to increase by the end of that month.
We have Milton Owino, who's asking, how does one compute professional income tax?
Income tax is provided for under the Income Tax Act, and if you look at the charging section, the way it defines, it talks of any income that is earned by a resident as well as an unresident person, which is accrued in or derived from Kenya. So that is the basic definition. And as I started by saying, is that any person, and when I say person, I'm referring to both natural and unnatural persons, has the obligation to pay taxes in Kenya. So per se, there's no one who is expressly exempt, maybe with an exception of, for example, the individuals with disabilities who have that exemption. But maybe just to try and contextualize it in the context of the question is professional income tax. Then, if you are doing it as maybe if you are doing the business through a company, the default way to pay your income taxes is you have the whole year to make sure that you do your sort of statutory audit, determine your tax loss, basically your profit or loss before tax. Then there are those expenses that are tax deductible, there are those that are non-tax deductible. So you arrive at your adjusted taxable profit or loss. If it's an adjusted taxable profit, then you'll pay tax at 30%. That is for non-individual persons, so companies as well as partnerships. So I think those would fall under, and limited, and partnerships largely would fall under that category. For individuals, it's like I mentioned, similarly, an individual is still a person, and whether that individual is resident or non-resident, then there is a requirement to similarly pay tax. Now, for an individual by themselves, the way they can actually compute the tax, instead of outrightly using the 30% rate on gains or profits, you can actually use the graduated rates of tax for an individual person. So it will start with the 10% bracket as you move all the way up to the 35% bracket, which is the highest bracket. So an individual would have to compute taxes on that basis. Remember, if I was just to sort of interpret professional income tax, so if this individual is involved in providing, say, professional consultancy services or training services, what they should expect, and if these amounts are more than 24,000 shillings per month, is that the person making the payment will always deduct withholding tax at 5%. That withholding tax is not lost. That withholding tax deducted at source is actually a credit against which that individual can utilize to knock off against his overall tax at the end of the year.
All right, so there's a number of questions that are on withholding tax, but before we get to that, there's someone here who's asking, how does one claim for tax reliefs from insurance policies?
You're supposed to provide your insurance certificate to your employer so that the employer, when they are calculating your payroll taxes at the end of the month, they're able to factor those reliefs.
So if I take a loan from the bank, build a house for rent, why is the government asking me to pay tax when I'm already paying for the loan? That is one of those questions on income from rental property. I believe there was another question here that was in relation to that. I'm just trying to find it. However, James, you can go ahead and answer that as I try and get the other questions relating to that.
Yeah, thank you, Jimmy. Maybe just to answer that question. What is coming out is a concern as to why this person has an obligation to the bank in terms of getting the loan to, say, either construct or to acquire the rental property from which they'll be earning rent. And that's where a decision on how to approach that issue of rent comes in. So number one, I think the first consideration is it a commercial property or is it a residential property? Outrightly, if it's a commercial property, the only way this person can account for income tax is 30% of gains or profits. So that one is not debatable.
Yeah.
Now, if it is a residential premise, this person actually has the opportunity to take the monthly residential rental income tax regime, where they will pay 7.5% as tax every month on the rent they receive. Now, the trade-off comes here. If this person has an obligation to the bank because they secured a loan to either acquire the property or construct it, then it's up to the individual to weigh where does he stand to benefit more. Because remember, on the loan that they owe the bank, they are paying interest. Interest is a deductible tax expense. And I think at the end of the day, numbers don't lie. So if to that particular individual, and I'm assuming whether they're doing it through a company or as an individual, is to weigh the benefits of, and it will be pegged on the amount of rent that is being earned, any other expenses that they are incurring, in addition to the interest expense. If you find that the trade-off of knocking off interest expense, any other business-related expense against the income, it gives you a lower profit, and the 30% tax does not really give a dent compared to having to pay 7.5% of the gross rent, a decision can be made based on which of the two is more beneficial to that individual. Because if there is an advantage in taking advantage of claiming the interest expense to reduce the profit, then well and good, is still a viable option.
All right, so just in relation to that question around housing income, one of the things that Walter Tsuma is asking is, what is the minimum VAT payable for house income? I believe he's talking about rental properties in that case. And we have Maggie Wenjiro who's asking, please share the personal exempt from NHL, which I believe she wanted to ask the affordable housing levy or the national housing levy. So maybe, James, you can pick on on Suma's question, asking what is the minimum VAT payable for house income, if there's any, and then we can have Kevin also just take Wanjiru's question on if there are persons exempt from the affordable housing levy.
Okay, thank you. Just to address the question, okay, it's not coming out clearly minimum VAT, but what normally happens is this, and all of us can attest to the fact that on the residential premises we live in, we are not charged VAT. And the reason is because the sale, letting, leasing, or hiring of residential properties is VAT exempt. So the landlord who owns residential premises should never charge the tenant VAT on residential premise. However, on commercial premises, if the rent received per annum for the commercial property will exceed 5 million shillings, the landlord must register for VAT and must charge the tenant's VAT at the rate of 16%, depending on the amount of rent. So per se, it's not that there is no minimum VAT. It works in those sort of categorizations. Is it residential property or commercial property? Maybe one thing I can also add, it's not that it will all be lost to the tenant. If the tenant is doing a business and they've rented commercial space, whatever VAT they are charged by the landlord, and they're using the premise to do their business, whenever they're also computing their VAT, because remember they also have an obligation, if they're dealing with taxable goods or taxable services that are subject to VAT, they should also equally register, charge customers VAT. The reprieve they get from the VAT charged by the landlord is that they can knock off that in the form of input VAT against output VAT to reduce their VAT bill every month. So that ideally would be the approach from a VAT perspective.
All right, and just before we get to Kevin, there is Francis who's asking, please confirm if rental income should be subjected to housing levy.
Okay, thank you, Jimmy. The first question, I want to address it this way. The issue of housing levy, we all know what happened through Finance Bill and Finance Act 2023. There was a lot of hue and cry about the implementation of affordable housing levy, the litigation that went through, the declaration of the unconstitutionality of the affordable housing levy as introduced by Finance Act 2023. Subsequently, and in speeds that we have not seen before, there was the publishing of the Affordable Housing Bill, enactment into Affordable Housing Levy Act. There are a lot of gaps that were left in that act in terms of providing guidance on what needs to be done. There is the issue of regulations, and I'm mentioning this because there is already a High Court case that is pending determination on the issue of the Affordable Housing Levy Act 2023. And some of the issues that have been challenged are issues to do with the regulations that were to be issued to provide for the enactment of that act and to provide more guidance. Remember, an act provides at a very high level what needs to be done. They are what we call guidelines that are supposed to provide the nitty-gritties of how that is supposed to be implemented. So the act mentions that even non-salaried individuals, and I want to take that question with the next one about rental income. Non-salaried individuals are supposed to pay affordable housing levy on their income. The act does not provide what is this income that will be subject to affordable housing levy on persons who are not salaried. So that was supposed to come in forth with the regulations. The same was supposed to provide, are there any persons who are supposed to be exempted from affordable housing levy contributions? My own thinking would be, if I have a mortgage that I'm paying and I'm being deducted that interest, or I'm paying interest to that mortgage, by any chance I should be exempted from affordable housing levy contributions. But that is not yet clear because the regulations have not yet been provided. In the same breath, affordable housing levy contributions by non-salaried individuals is also not yet clear about what is that income that should be subject and how are you going to compute that income. You're talking about people who are in informal employment or in informal businesses. How are they going to compute their income to be subject to affordable housing levy? I think from my observation, it was just put in there to cure the deficit that were pointed out by the High Court, but its implementation was really targeted towards salaried individuals because for easy implementation, that's the low-hanging fruit for the government to nab people to pay affordable housing levy contributions.
All right, so James, we have Abdirizak Mohammed who's asking, are independent consultants or individuals allowed to offset expenses incurred in generating the income?
Thank you, Jimmy. The answer is a simple yes. They are allowed to offset any expenses they incur in the course of providing the basically the consulting services.
All right.
Yeah.
So, Kevin, you spoke about the 2.75 shift reduction, and we have Nilesh Agarwal who's asking, is there any upper limit as to the shift payment per individual?
Unfortunately, no.
And of course, I expected that question to come because there was a lot of conversation in between on whether there should be a limit or not.
Yeah, maybe just to expound on that, I think in the early stages of the shift, the Affordable Housing, the Affordable Healthcare Act, the SHA and the shift, in the early stages of those bills, there was the talk and the conversation of there being an upper limit on the contributions. Unfortunately, when the bills were assented into law and they became act, they do not provide for any upper limit in terms of the contributions.
All right, James, I believe there's a question that comes from a conversation that was happening yesterday on TV, and someone is asking, does a reduction in VAT mean less contribution, or does that mean increased joblessness?
Wow, interesting question, which I don't have an accurate answer, but what we've actually seen is when affordable housing came in, and maybe also this should be a lesson to Kenyans. Kevin and I were actually involved in making the submissions to the Finance and Planning Committee on the Finance Bill 2023. Now, if you think about it back then in the bill 2023, affordable housing levy was at 3% on the employee's gross pay, matched by 3% on employer. But there was a cap up to 5,000 shillings. And the Kenyans, we made a lot of noise. And the government went back to the drawing board and gave us a worse position to be in, because it's now 1.5% employee matched by another 1.5% employer with no cap. So they did away with the 5,000 shillings. Not a similar case with SHIF. I think SHIF is outright. When they brought it in, the intention was just to be 2.75% on gross without a cap. Now, maybe I'll just touch so much on the implication of affordable housing. By the employer having to match, it obviously results in an increased cost to the employer, because you see, the employer also has to go out of pocket to match that. Now, the reduction in the pay as you earn, basically that payments that were made in the previous month is largely attributed due to two issues. The first issue, you find that a lot of employers have tax refunds. So the tax refunds could be income tax refunds because of overpaid withholding taxes, installment taxes. They could have tax refunds in the form of VAT refunds. Now, what the law allows, when you get your refund approved, you can actually, instead of waiting for the cash, because again, the issue of payment of tax refunds is another issue for taxpayers, the law allows you to apply for an offset. So what an offset basically means is I have X amount in a VAT refund due to me, already approved. I can choose to notify the commissioner, I want that refund applied against other tax obligations. So I receive what is called an overpayment adjustment voucher. So every month, when it's time for PAYE, all I need to do is key in the acknowledgement number. Then I'm able to offset the PAYE after I've filed my return. So there is no actual pay-as-you-earn payment. The payment has actually been made because you see it's just from one hand to the other. The government would have paid me my VAT refund in cash. Then the same cash I've received, I use it to pay my pay-as-you-earn obligation or my VAT obligation or income tax obligation. So one of the reasons that is contributing to reduction in pay is a lot of employers or companies who have other tax refunds that they are using to knock off against the monthly VAT. The other issue, obviously, times are tough. It is a reality. It's just today morning I saw, it's there in the public domain, I can mention it, G4S is to lay off almost 200,
about 400 actually.
About 400 employees.
All right, just to mention something. But anyway, let's move forward with this conversation. Now, James and Kevin, we've talked a lot about some of these new challenges that are coming in. We've talked about taxation, and they just seem to be piling up. The more we talk about them, the more creative we seem to be getting with introducing new taxes and new levies. The question that I'm sure a lot of our audience this morning would want to know, is there a silver lining at the end of it? Kevin?
Well, Jimmy, I think my first answer to that is that, yeah, we are operating in very unpredictable times in terms of taxes. We don't know what to wake up to the next day because even the raft of public notices that we are getting on a daily basis, I think the most recent one being something to do with registration of mobile phones, IMI numbers with the KRA and verification of that. We are not certain about where we are heading from a tax perspective, and that unpredictability is not good both for individuals and for businesses. But I think the only thing we have to do, at the end of the day, taxes are pegged on tax law, and we have to follow tax law. If it is provided for in the tax law, the best we can do is implement that and follow. But at the same time, maybe it's to call on people that whenever we are given an opportunity to put forward our submissions, our proposals, our remarks on certain tax changes, I think we should seize that moment and ensure that our voice is out there and heard in terms of some of these tax proposals that are being provided on a day-to-day basis. But in terms of do we have an option, do we have a choice, I think our options, our choices are so limited to the extent that most of these tax changes are anchored under the law, and the least we can do is abide by what the law provides in terms of the taxation measures.
All right, and James, just talking about the shift and the housing levy, and the amendments that have been coming on. One of the things that we know is that these are going now to, should some of the proposals be passed, one of the things we are likely to see is that SHIF and affordable housing levy will be brought forward and then be calculated minus those contributions. And the question that I would want to know is, does then that relief make a difference to my disposable income at the end of the day, or is it too little?
It does. And Jimmy, I would want you after this webinar, I believe you know how much you earn. Just go recompute.
Yeah.
You already know what the 2.75% of your gross is. You already know what the 1.5% of your gross is. Just take that total figure, take it up there in your payslip, deduct it in addition to pension contributions, then you arrive at the new taxable pay, then now subject that taxable pay to the graduated scales. The benefit is far much more than the reliefs. So actually that is a very welcome proposal. It was, unfortunately, with the withdrawal of the Finance Bill 2024, even all the good things went away. And Kevin alluded to the fact that, honestly speaking, I think we are being hoodwinked, being given sweeteners before the end of the year. Then in less than 4 months, come 2025, by April, we will be contending with a finance bill 2025 that might have similar things that were there in the finance bill 2024. Though I don't want to be political, then we will be told, but we gave you these goodies. Why don't you also consider the government's wants also to mobilize tax revenues?
Yeah.
So I think it's just some mind games being played here and there. And it's very unfortunate when you see some things that were in the finance bill 2024 that are actually being introduced, but they're not being introduced under tax statute.
Yeah.
And a typical example is the eco levy. It is being called something else, but for those who are very keen to look at those notices that are normally in the newspaper, it's actually eco levy, but it's being called something very different. So you asked about a silver lining. My answer is, to be honest, no. I guess we'll just have to wait and see the trend with the Finance Bill 2025. That will give an indication. But you see now the confusion comes. We'll just have barely a couple of years to the next election. Then it sort of skews the way the government is generally looking at tax policy. But the national tax policy is not being adhered to at all, because then there's no predictability.
All right, so Kevin, one of the things that we know is, or at least we have seen from the last couple of months, is the Kenya Revenue Authority has become quite aggressive in going for these taxes and making sure that everyone pays their fair share of taxes. And with that, then therein comes the question of penalties. And I'd want to know, for a lot of our audience today who are listening to us, most of them are either salaried or are in business or consultancy. How do I make sure that I don't get caught up with penalties that maybe I assumed that do not touch on my business, I assume do not touch on my services?
Okay, thanks, Jimmy. Yeah, it's true that we have seen a higher level of aggressiveness by the Kenya Revenue Authority in terms of compliance checks, audits, and even pursuing people who have tax debt to the KRA. Now, one thing that we always encounter in our daily professional lives is that most people are not aware about the tax obligations that they are due for or they are supposed to pay. And in other instances, you are aware, but what really gets people unaware is the timelines. If I'm to talk on something like withholding tax, there was the issue of the change timelines. We always paid withholding tax by the 20th of the following month. Now, effective 1st July 2023, we are paying it within 5 working days. Now, what we have seen, if I to point out like that particular scenario, if you are to go and pay your withholding tax and you key in a date that is outside the 5 working days, and then the system computes a late payment penalty. Now, what I'm pointing out to is that it's important for us, whether we are in business, whether we're in employment, to be aware of what tax obligations that we are supposed to comply with. And on top of that, we also be aware of the timelines of complying with those tax obligations. I don't want to do a free advert here, but it's always important that when you have a query, you get in touch with your professional tax consultant so that you are not caught out because of not being aware. The unfortunate thing, as I said, everything tax related is under tax law. The timelines are provided in the tax law, the due dates are provided in the tax law, and given in this day and age where everything we are paying on through iTax, the system will always be very prompt in calculating the applicable penalties and the interest. There is an upcoming amnesty if the Tax Laws Amendment Bill or the Tax Procedures Amendment Bill 2024 comes into play. We should take into advantage of that to clear our past tax obligations so that we enjoy the amnesty on the penalties and the interest. But going forward, I think it's always good for us to be in the know to ensure that we are tax compliant both from an individual and from a business perspective.
All right, so James, looking at the economic setup of this country and just looking at the macro, one of the things that we are seeing is a lot of Kenyans are looking for a secondary income. And one of the things that we are seeing, even salaried Kenyans, they're looking at business. They're looking at making investments. And the one investment that I would want you to help us understand is, are there specific investments that we can make to take advantage of some of the tax reliefs or the tax benefits that come with it?
Now, if I look at it from an individual perspective, and I'm trying to look at it also trying to balance with any tax advantages that might come in, and I think this is where also ABSA plays a critical role. I believe all of us, wherever you bank, if there's something that has been aggressively been marketed, the money market funds. There is also the issue of the infrastructure bonds, which come with currently with the exemption for withholding tax, especially if those infrastructure bonds have a maturity of more than 3 years. So currently it's tax-free. The tax laws amendment bill proposes to introduce withholding tax at 5%. Is still lower. And you see infrastructure bonds, the money market fund, these actually sort of is requiring an individual, number one, either to find a way to save from what they earn from their salary. Number two, if it's a business, for a business to be very prudent in terms of expenditure, so that at least there are surpluses that can be invested in these other investment options. Besides that, then it would go to the more traditional investments where someone could decide to start a form of a business, whether it's on a wholesale or retail basis. Someone could decide to venture in real estate, but where there seems to be a lot of traction and attractability in terms of savings. ABSA has all these products. You can decide sort of letting your money lie idle in your current account. You can either put it in a savings account or a fixed deposit account. So these are all really viable options. I see online a lot of computations being done on which is the best investment platform. It all depends also on the individual in terms of the capability to set money aside. But in a nutshell, what we see, even from basically our industry, because we have a lot of visibility on the financial performance of companies, I can assure you a lot of people are putting money aside in money market funds and bonds. And even banks themselves are actually putting money in these infrastructure bonds. So I think that seems to be the general direction in terms of investment.
All right, and Kevin, just in relation to that, there's a question around what specific tax exemptions can we leverage on to reduce overall tax liability?
Yeah, there are a lot of tax exemptions. Maybe even to pick up from where James has reached is that you see, when you invest in so many of these money market funds, you invest in fixed deposits, the withholding tax that is deducted by these financial institutions is a final tax on the individual. So you won't be required to pay an additional tax on that. The same thing happens when you invest maybe in shares, maybe in quoted shares. The withholding tax again will be a final tax at the rate of 5%. You won't be required to declare or pay additional tax on that. Some of those tax exempt, I think the most notable one will be on the infrastructure bonds, which has for a very long time been exempt from withholding tax. And even if the proposal in the tax laws amendment bill was to come into place, the 5% withholding tax is lower than the 15% that is levied on the other bonds that are floated by the central bank. So it's still a viable opportunity for people to take advantage of in terms of ensuring that they are able to take advantage of the tax exemptions that are provided.
All right, so James, we have George Murigi who's asking, can residential or rather tenants demand for ATM's invoices from their landlords?
Now, remember, the main purpose of eTIMS invoices is, number one, if you are a VAT registered person, to be able to claim any input VAT, or rather any VAT that has been charged on that invoice against your output VAT. And similarly, from an income tax perspective, for you to be able to support that expense with an eTIMS invoice so that that expense is deductible for income tax purposes. Now, I'm wondering, I'm assuming I'm a tenant. Now, I'm not doing any business in my residential premise, so I don't need, and remember, by the way, it's not that you just wake up and pick any expense and claim it for business. The basic rule of thumb in law is that any expense that is considered to be tax deductible must be an expense that is wholly and exclusively incurred in the generation of income. So the question will be, okay, even if I'm a tenant and I'm demanding for an eTIMS invoice, number one, I'm a tenant of a residential premise, so I don't expect any VAT on that invoice, so I cannot claim any input. It's irrelevant from a VAT perspective. Number two, I'm paying for a residential premise. Is that really a business expense? Not unless I'm saying I run my business from my residential premise, and the rent that I pay for the residential premise can be attributed to this small business or big business that I'm running from my residential premise. So yes, you can claim, and you need that eTIMS invoice to substantiate that cost.
All right, so Kevin, Julie is asking on iTax authentication for mobile and KRA data cleanup issues, and I think this is something we were talking about earlier on before we came on set. How is that likely to pan out, and what impact will that have?
Well, thanks, Jimmy, for that question, because I would say it's something we're also trying to deliberate. What is the motive? Is it that KRA wants to be communicating directly to persons through the mobile number, or else there is a straight avenue? Because for every PIN, there has to be an email, an tax registered email to which you are supposed to get your communication. Is it that KRA wants to be communicating now directly through a mobile number? Is it that there is an enhanced level of, I don't want to call it, I'm trying to look at the correct word, that KRA wants to look at your tax affairs, maybe from your mobile phone dealings. I think it's something that we are still deliberating on. When that notice came out, it does not provide the reasons why that is being asked for or provided for. But we would hope that the motive is not one that will end up with the tax authority being over inquisitive of on spying on people's mobile phone activity. And the most notable one, so the easy one that comes into mind, is what impact will this have on our mobile money payments and activity through the mobile money. So I think it's something we are still trying to wrap our minds around as to the intention. And I think it's something that ought to have come out. It's a public notice that was issued with some more guidance, because you see, some of these issues are what is causing a lot of resistance from taxpayers in terms of complying with some of these guidelines that are being provided.
All right, so James, there's a question around tax amnesties. Are there any tax amnesty that you're currently aware, and what kind of tax obligation does it apply to? And even as you answer that, maybe you can start preparing your closing remarks.
Yeah, thank you for that, Jimmy. So the issue of tax amnesties, Kevin has already mentioned it. Mm-hmm. The only first, before this proposal in the tax laws amendment bill, the amnesty that was there ended on 30th of June 2024. So as we speak, there is no form of amnesty. As we speak, if you have any non-tax compliant issue that has accrued penalties or interest, the penalties and interest are payable. previously, prior to 1st July 2023, you could actually apply for a waiver of penalties and interest. That provision was done away with the Finance Act 2023. What we are hoping is this proposal in the tax laws amendment bill will sail through with a potential extension of the period from 31st December, maybe even until 2024, so that it's beneficial to a lot of taxpayers. But the way that amnesty is fashioned, I think it needs to be clear. It is only amnesty that is giving reprieve for penalties and interest. Everyone will still be required to pay the principal tax that is unpaid up to a certain period. Currently, it still reads 31st unpaid principal tax up to 31st December 2022. The hope is, given the economic hardships and struggles, they can extend this, maybe, and say unpaid principal taxes, maybe up to, say, June 2024 or something, to give guys at least a window to check their cash flows and pay. Then they get the reprieve for penalties and interest. So that is the only amnesty that we are looking forward to. There is no other amnesty as we speak.
All right, so Kevin, in closing, what is the way forward? What do our audience need to prepare for going into 2025? And also just looking at some of the tax amendment laws that are being proposed by the National Treasury.
Okay, thanks, Jimmy. I think for our audience, the call is that we're operating in very uncertain times, very unpredictable times in terms of tax changes. What I would call on everyone is that let's ensure that we are also up to date in terms of what has changed from a tax perspective. Where you are not clear, please get in touch with your preferred tax consultant, because I think going forward, what I would say is that we need to tighten our belts. We don't see it getting any better going forward. I think from the outlook is that the government needs to collect more and more, taking into consideration the issues we have with the debt obligations, the economy not doing very well. I think it will come with an additional collection pressure by the Kenya Revenue Authority on taxpayers. So it's for us to ensure that we cushion we tighten our belts. We be aware of the tax changes and the tax statutes that are coming in place to ensure that we are not caught out because of lack of knowledge. And at the same time, maybe it's also important that we also take part in the forums that are being called for to provide or to issue our voices in terms of public participation. And where we feel that the tax proposals are quite punitive, I think it's very important that we have many voices that are coming out to call out on the punitive taxes. And where we have good proposals, we take advantage of them and we maximize on them. I think that's my closing remarks, Jimmy.
All right, thank you so much, Kevin. So, James, in closing, what should we be looking out for in 2025, and how do we best prepare for that?
I'm a firm believer in information is power. And even before I just give remarks on the outlook, our hope is that we've been able to impart knowledge just to create the awareness. Because even if you keep looking forward, right now, if you don't have the information and you don't know what to do, then even in terms of making a decision, then it becomes difficult. So at least this is a first step in terms of sensitization, creation of awareness, just to know your tax obligations, because those are static. Those are really there. They are provided for in law. In terms of general outlook, our hope, and this will make sure we will repeat to the Finance and Planning Committee when we make submissions on the tax laws amendment bill, as well as any other future bills, is strict adherence to the national tax policy, because then our tax regime is not favorable not only to businesses but even to foreign investors, because businesses cannot be able to plan for taxes. Every year there has to be a change, and radical changes. So it makes it also very difficult for a business to actually plan for its operations because of that unpredictability. So our plea is basically for government to just try and follow the national tax policy, which actually says that we could go for a period of 5 years even without changes in any tax law. So, but we are not seeing that. So was it just a document that was prepared to tick a box or what? But I think there's no commitment from the government on that. We still expect a lot of unpredictable stuff. The tax laws amendment bill we are discussing must be an act of parliament before the end of this year. So whatever we are discussing will be actualized first come January 2025. The problem is barely 4 months down the line, since the beginning of next year, we'll be grappling with another set of changes. So that is the outlook, whether we want to admit it or not. I think the necessary pressures were already put from a demonstration and mobilization point of view to show the displeasure. But to be honest, it's actually very difficult to say how the trajectory looks like, especially in light of just something I saw yesterday, that there was a default on the SGR loan, almost to the tune of 165 billion. So does that increase or reduce the pressure? Definitely it increases the pressure. Yeah, that's the general outlook, I would say.
All right, gentlemen, thank you so much for making time to be here with us throughout those 2 hours of quite an engaging session. And to our audience online, we just want to remind you that if you feel or filed any question that has not been addressed, kindly make sure to send questions to ABSA Prestige Banking at absa.africa. That is the email. I'll repeat that one more time. It's ABSA Prestige Banking, KE at absa.africa. You can channel your questions there, and of course we will make sure that the right team gets to you and responds to all the questions. That is the end of our session this morning. Like we said, this is one in a chain of many that are going to come. We will be engaging you on these topical issues just to make sure that we give you all the tools and all the information you need to be able to plan your financial wellness going into the future. A very hearty thank you to James Mulili, Tax Director at PKF, and also Kevin Chege, another tax manager at PKF. My name is Jimmy Mbogo. I've been your host this morning, and we look forward to doing this again in the coming days.